ROIC at the end of the forecast period might be very different from today's. The continuing value calculation needs to be consistent with the assumptions about the company's performance in that future steady state. Often, specific formulas based on expected long-term growth and ROIC are used, linking back to the value driver formula.
Needs to be fundamentally grounded. And how long should that explicit forecast period be?
Long enough for the company to reach that steady state you're assuming in the continuing value. If you expect margins to compress over the next 7 years due to competition, your forecast needs to be at least 7 years long. Once the company hits a stable performance level in your forecast, extending it further usually doesn't change the total value much.
Okay, let's switch back to the cost of capital. Estimating the cost of equity using DAPM, the capital asset pricing model. How does that work?
CAPM estimates the return investors require on an equity investment. The formula is risk-free rate plus beta market risk premium.
So the return on a safe asset plus a premium for market risk, adjusted by the company's specific sensitivity to market movements. Beta.
Precisely. Beta measures how much the stock tends to move relative to the overall market. A beta above 1 means it's more volatile than the market. Below 1, less volatile.
How reliable is beta for a single company?
It can be quite volatile and statistically imprecise for just one stock. That's why the book recommends using an industry beta, the average or median beta of comparable peer companies. It's generally a more stable estimate.
And that market risk premium, the extra return investors expect for holding stocks over risk-free assets, how do you estimate that? It seems crucial.
It is crucial and tricky. You can look at historical data. The book mentions the U.S. market delivered about a 7% real return on average from 1962 to 2018. But historical data has issues like survivorship bias.
Meaning we only see the results for markets that survived, potentially inflating the average.
Exactly. Adjusting for that, the book suggests a market risk premium range for the U.S. of about 4.7% to 5.4%, often rounded to 5%. You can also derive implied premiums from current market valuations.
So around 5% is a common estimate. How do you refine the industry beta estimate you mentioned?
It's a process. First, find a good set of comparable companies. Calculate the historical beta for each. Then you need to unlever each beta, remove the effect of that specific company's debt level to get an asset beta.
To make them comparable on an operational risk basis.
Right. Then you look for outliers, maybe remove them, calculate the median, often preferred over the average as it's less skewed by extremes, of the unlevered betas. You might also relever this median unlevered beta using your target company's debt structure. It's also good practice to see if the industry beta has been stable over time. Exhibit 15.7 shows how betas changed during the dot-com boom, for instance.
CAPM is standard, but the book mentions the Fama-French model, too.
Yes, the Fama-French three-factor model. It adds 2 extra factors to CAPM, besides market risk.
Which are?
SMB, which captures the excess return of small-cap stocks over large-cap stocks, and HML, the excess return of high book-to-market value stocks over low book-to-market growth stocks.
So it suggests size and value growth characteristics also carry risk premiums.
That's the idea. If a stock's returns are correlated with small stocks or value stocks, this model suggests it should have a higher expected return than CAPM alone would predict.
Okay. What about the other side of capital, the cost of debt? How do you estimate that?
Usually, you start with the company's credit rating from agencies like S&P or Moody's. That rating reflects their assessment of default risk.
Like AAA, AAA, BBB, etc.
Exactly. Then you look at the typical yield spread for bonds with that rating over the risk-free rate, like Treasury bonds. That spread represents the extra yield investors demand for taking on that credit risk. Exhibit 15.10 shows these spreads. Adding the spread to the risk-free rate gives you the company's estimated pre-tax cost of debt.
Simple enough if they have a rating. And the interest tax shield, how does that fit into WACC?
Right. Interest payments are usually tax-deductible, which lowers the effective cost of debt. While NOPAT and free cash flow are often calculated on a pre-interest, all-equity tax basis for comparability.
You need to account for the tax shield's value somewhere.
Exactly. It's usually incorporated into the weighted average cost of capital, WACC calculation, by using the after-tax cost of debt. Or, as mentioned, it's valued separately in the APV method. Chapter 16 and Appendix C get into the details of calculating WACC and the tax shield value.
Okay. We talked about invested capital being operating assets minus operating liabilities.
Yeah.
What about assets that are not part of core operations? Excess cash, investments.
Those are non-operating assets. They need to be valued separately and added back to the value of the core operations derived from the DCF or economic profit model to get the total enterprise value.
What qualifies as non-operating?
Things like cash held above what's needed for operations, marketable securities, investments in affiliates accounted for under the equity method, excess pension assets, assets of discontinued operations, things not directly generating the operating cash flows you forecasted. You have to be careful not to misclassify something essential, like maybe the land under a retailer's stores.
And those equity investments in other companies, 20–50% ownership, how are they valued?
Those non-consolidated subsidiaries, accounted for using the equity method, need their own separate valuation. You'd use available financial information about the subsidiary, perhaps apply industry multiples, or use other valuation techniques, and then add the value of the parent's stake to the parent's overall valuation.
Okay, separate valuation for those. Scenario analysis seems like a powerful tool for handling uncertainty. How does it work in practice?
It's about more than just tweaking one variable. You develop several plausible, internally consistent stories about how the future might unfold, focusing on key uncertainties.
Like a high-growth scenario, a recession scenario.
Exactly. For each scenario, you build a full financial forecast and calculate the resulting enterprise and equity value. Then, and this is key, you assign probabilities to each scenario. The final valuation isn't just one number, but a probability-weighted average of the scenario outcomes, giving you a richer understanding of the potential range. Exhibit 16.3 shows this.
What about things like convertible debt or employee stock options? They affect share value.
They do, and valuing them can be complex, often requiring option pricing models like Black-Scholes. Exhibit 16.4 discusses convertible debt valuation. The value of these claims is typically subtracted from the total equity value before dividing by the basic shares outstanding to get the per-share value for existing common shareholders.
So treat them as claims deducted from equity value. Sensitivity versus scenario analysis. What's the difference again, and why do both?
Sensitivity analysis changes one input variable at a time, like revenue growth or WACC, to see how much the final valuation changes. It tells you which assumptions are most critical, the key value drivers.
Helps identify the big levers.
Right. Scenario analysis changes multiple assumptions together based on a coherent narrative about the future. It helps understand the potential range of outcomes and the strategic implications under different future conditions. Doing both gives a much deeper understanding than just a single base case valuation.
Makes sense. Let's talk about valuation multiples. The book has some advice there. Better to use forward estimates.
Yes, forward-looking estimates of earnings, like EBITDA or NOPAT, are generally preferred over historical ones as valuation is inherently forward-looking.
And which multiples are best? Not PE.
The book leans towards enterprise value multiples, like EBITDA or even NOPAT, rather than the price-earnings PE ratio.
Why is that?
PE is affected by the company's capital structure, how much debt it has, and can be distorted by non-operating income or expenses. Enterprise value multiples focus on the value of the operations relative to operating earnings, making comparisons between companies with different debt levels more meaningful.
And the importance of picking the right comparable companies when using multiples.
Absolutely critical. You can't just use a broad industry average. Exhibit 18.11 highlights how much multiples can vary even within an industry. You need to find peers that are truly similar in terms of their business mix, growth prospects, and crucially, their ROIC.
Performance matters for comparability.
Hugely. Ignoring differences in ROIC, for example, can make metrics like the PEG ratio very misleading. Exhibit 18.12 shows this.
For companies with multiple divisions, sum of the parts valuation is often used. What are the benefits?
It can provide much better insights and often a more accurate valuation, especially if the different business units have very different economic characteristics, different growth rates, margins, capital needs. Exhibit 18.13 uses a consumer co example to show this.
You value each part separately using appropriate peers and methods.
Exactly. Then you add them up, making adjustments for corporate overheads and debt. Trying to value a complex, multi-business company with a single blended multiple or set of assumptions can obscure a lot of important detail.
Gives you a clearer view of where the value lies. Do you often need to adjust the reported financial statements before using them in valuation?
Yes, quite often. Reported accounting numbers aren't always ideal for valuation. Exhibit 20.6 uses Walmart to show how you might adjust reported taxes, for instance, to get a better estimate of the underlying operating tax rate for forecasting NOPAT.
What about non-operating items, provisions, reserves? How are they handled?
You need to look closely. While a simple DCF might ignore one-time non-operating charges, the nature of these items can matter. Exhibit 21.1 discusses amortization of acquired intangibles using Pfizer. Exhibit 21.3 talks about different types of provisions. Some might be truly operating, others non-operating or related to restructuring. You need to understand if they reflect ongoing business costs or genuine one-offs and how they impact future cash flow.
Requires judgment based on the specifics. What about valuing businesses with very little capital? Service businesses, maybe.
Right, capital-light businesses. Exhibit 24.9